Good afternoon. Thank you for joining us today for ROK Resources Q3 results and operational update. ROK trades under the ticker symbol ROK on the Venture Exchange and PTDRF on the OTC. They have free trading warrants with a strike price of 25 cents, which expire March of 2025. With us today from the company are COO Brian Wright and Senior VP of Land and Business Development, Jared Lukomski. As always, the presentation may contain forward-looking statements. If you have any questions, please enter them in the Q&A box. Jared, do you want to start off with some highlights and congratulations for meeting your year-end exit number of 3,500 that you had forecasted already in Q3. So do you have any other highlights from the quarter you want to touch on quickly before we go to some of the questions I have?
Yeah, go ahead, Bryden. I think Bryden has a bunch of smart things to say, hopefully.
Yeah.
Okay.
Yeah, no, it was a good quarter. We continued our drilling program in Southeast Saskatchewan. So I think in Q2, we began that post-breakup, and we continued that through Q3. We added a significant amount of locations out in Southwest Saskatchewan as a non-op partner with Whitecap in the Butte area. So those are Shaunavon wells, lower Shaunavon wells, and had a decent amount of success with those IP rates as well. So overall, a quarter that we were happy with. You mentioned we met our 3,500 BOE a day guidance for year end a little bit early than we had expected. So that was positive. I think we met expectations on our funds from operations. And our net debt as well. I think we're at just over $30 million net debt at September 30th. So, we continue to bring on wells and drill in Q4, both operated and non-op. And so busy quarter and we're excited to kind of get to year end and move into 23.
Perfect. Yeah, there wasn't a ton from the press release as far as operations go. I know you guys faced some delays as far as timing on drilling. So assuming results will be more in early Q1 when you put out your budget.
Yeah, so that is the plan. We initially intended to release a budget in November for 23, and that was all along the plan. But we have had some delays, I think, like a lot of producers, just with labor shortages, and it's more on the construction side, getting wells tied in, getting wells completed, things like that. So our expectation, we do have 1.3 net wells, I believe, to bring on production from Q3. So wells that were drilled in Q3 that are either being completed, equipped, or tied in. And then throughout the course of Q4, we have an additional 2.2 net wells that were, I believe they're all drilled now. So now it's just in the process of equipping and tying in those as well. So, hopefully have some positive results with those wells. There are some shut-ins on the Alberta side with some of our gas. TC still having some maintenance going on in their system. So we do have some gas that's currently shut in and delayed into December. So we're hopeful that we'll have that on production by year end. But yeah, we're continuing to be busy right through to year end. So come January, you'll see an updated budget released to the market.
Okay. And remind me if the shut-in number was about 300 BOEs a day?
No, so currently it's about 125 BOEs a day in Alberta that's shut in, and that's been shut in for a couple months now, and that's gas. That's all gas.
Yeah.
And then we have, in addition to the net wells that I mentioned on the drilling side, we do have a reactivation program that's underway in Kaybob. So it's a 9-well program. Phase 1 is I think it began in October, and so we're hoping that we'll have one of those locations on prior to Christmas, and the remainder probably on by the end of Q1. So, but as far as current locations shut in, it's about 125 BOEs a day in that range.
Okay. What did I think?
Sorry, back to that well reactivation program. The capital efficiencies on those were really, really strong. We had tested that theory out on a number of wells initially, and between 7,000 to 10,000 per BOE per day. So really strong capital efficiencies on that. And Bryden spoke of, we've got a 9 program reactivation that we're doing in the Kaybob area, so that should be added in Q4 as well.
So how many of those 9 wells have you, out of that program have you done thus far?
Just one is completed, but we're waiting on TC to allow us to get our gas back online. So it's going through a Paramount facility. And right now I think the date they gave us recently, initially it was December 1st. I think it's December 12th is the on-stream date. So that will bring on the shut-in production plus one of our reactivations. And throughout the course of December, we'll be continuing to work on the other projects. But the expectation is the bulk of those will be coming on in Q1.
Okay.
And I think that's maybe where you got the 300 barrel.
Yeah, I think that's where I did. Yeah.
I think our estimate for the that 9 well package is about 300 BOEs a day net.
Yeah. That's where I think I've screwed up there. Yeah. So do you have beyond, do you see any more, if those 9 work, do you see other reactivations you can do in the area, or is that kind of it?
As far as just reactivating wells, that's it right now. That said, there's 3 or 4 locations with actually of those 9 with bypass pay that we're looking at. We're currently evaluating that. So there's zones that, there's anywhere from 4 to 6 zones of producing quality in the Kaybob area in this specific area. And so those 9 reactivations don't include actually reperfing or perfing bypass pay. So that'll be an additional project that will come after we get the wells on stream. Really, it's more of an infrastructure piece, reactivating pipelines, getting engineering assessments done on flow lines or pipelines that were shut in back when gas was $1, and just doing work with the AAR to get those compliant. And so that's the bulk of the work, and really not a lot of downhole, to be quite honest. So the next step after phase 2 of the reactivation would be looking at some of those opportunities.
Okay.
And then in Q1, we do have plans to drill a well with Whitecap up in Kaybob. So that will be likely one of the first things we do in Q1. There's a little sync.
Okay. And that will be, you said, so you were initially, I thought we're having some issues with tying up a rig that's tied up now for that. Yeah. Okay. So that'll be exciting.
It's a Cardium well. So it's our first location up in Kaybob that we're drilling, and actually Whitecap's the operator. We're the majority interest holder there, but they do operate up in this area. So it's exciting. Absolutely.
Yeah, and it's a whole new area that you guys haven't really focused on yet, except for the reactivations, right? So there could be a lot more news coming out of that area here in the next 6 months, I would assume.
Yeah, absolutely. It's been, it feels like we've owned this asset for a lot longer than 7 months, but we did the deal in March. We closed it in March. And so it's been a matter of trying to digest the assets, go after some of the low hanging fruit in Kaybob, where Cardium and Montney wells are a lot more expensive than a Southeast Saskatchewan well. So we want to be smart with our capital and test some theories out just on the workover reactivation side of the coin. And then, as we identify some of the lower risk drilling, that's where we're starting. And so this well up with Whitecap is offsetting some really nice Cardium production of theirs. So.
Okay. We'll look forward to that. And do you want to talk any more on Kaybob, or do you think there's anything else we should be focused on, or kind of wait for those results? Then we'll have a good handle on what you'll be focused on in the Cardium after that.
Yeah, I think, so Kaybob is, we have Cardium, we have Montney, we have Gething, we have Blue Sky, Dunvegan. We have a lot of different horizons to target. A lot of them are already producing. We've recently drilled a non-op well with Outlier in the Gething that on test looked really, really solid. And so that's going to be one of these wells coming on in Q4. So we do expect some non-operated activity in 2023 in Kaybob. So I think it's a matter of, discussing those with our partners, really seeing how the rest of Q4 shapes up, and then, developing that program for 23. So I think it'll be a mix of Southeast Saskatchewan drilling and a little bit more in Kaybob. Absolutely.
Okay. And that Gething well, is that cleaned up now?
Yeah, they're just tying it in. So they're expecting, again, early December that to be on production. So they tested it. It looked really strong. And it's about, 90% gas, 10% liquids in that range. And we're 30% on that well. So yeah, it's exciting. It's exciting to get some gas on in, these winter months when prices are, pretty strong right now. And, hopefully have three or 4 months of strong prices there to, take advantage of those IP rates.
Awesome. And are there offsetting wells in that Gething play?
There is, yeah. This is the first horizontal on this block of land. It's basically a block a little bit outside to the east of our core Kaybob, Cardium Montney plays, but there is some offsetting upside, assuming this comes on as we expect it to. So hopefully a nice reserve add for us and future location as well.
Awesome.
Kaybob would be one of our biggest growth areas, just with the sheer amount of land. We've also picked up 5 sections of crown land at a number of Alberta crown land sales. So again, a big area of growth for us and an area that we're excited to spend some capital on.
And how are your partners? They're pretty committed to as well, up in that area to, to basically with the program that you envision having.
Yeah, like we're in communication. Really, we have 3 primary partners up there: Hawthorne in the Dunvegan, Outlier in this Gething area, and then Whitecap in the Cardium. And so I think for the most part, the development at Kaybob will be, led by ROK in terms of our operated focus on the Cardium and the Montney. And that will, that will probably start kind of mid to late 23, depending on how the budget ends up rolling out and how prices look. But our partners, again, this Outlier is the first well on our joint lands. And so that could lead to more development, I think, assuming, gas prices hang in there. And then as far as the Dunvegan goes with Hawthorne, I think, we have maybe room for 1 or 2 more locations. So it's not an area of huge growth for us. But we wouldn't be surprised if we had 1 more, say, next year with them.
Okay.
We do have a bunch of locations that are I guess land that is 100% ROK. So we have strong partners, but we also have a big 100% operated portion that, again, we'll look to spend capital in 2023 on.
And we should expect that plan. So like early, we'll see that in the January budget, or do you want to see how some of the drilling goes first before you come out with that?
I think we may pencil in, some development later in 23 in that budget. That's my my thoughts as far as when we'll put that forward. But again, as far as, being aggressive on the Cardium, I think it really depends on pricing, and of course the results in that first well. So you won't see a significant development program in 23 in that January budget. I don't foresee.
Yeah, and when we talked about Montney, you were thinking Q3 of next year was when you were looking to do that, right?
Yeah,
your first Montney well.
That's right. Our conversations have been focused around getting that first Montney well drill ready for, Q3, so that we could put that on production for Q4 right at the beginning of Q4 to take advantage of that pricing. So really, that's very dependent on gas pricing and the strength of AECO. And, it's anybody's guess right now what that's going to look like a year out, I think. So that'll be, again, maybe penciled in, but it'll be a pricing driven decision, I think. Okay.
And what price, as far as we'll say on the Montney, what kind of gas prices do you need to see to in order for you to want to drill that well?
North of $5 for sure, I think, is what we want to see for that winter pricing mechanism. So, similar to what we're seeing now, I think would be comfortable. Anything below that would be a bigger discussion. And, I think obviously our results in other areas in terms of what our cash flow looks like, how strong our balance sheet is heading into that quarter will help dictate that. But, if gas prices are in the $3 to $4 range, I don't envision us drilling that Montney well quite yet.
And on the Cardium, sort of what is your cutoff for oil prices?
As an average, we would like to see $90 oil. The well up that we're drilling in Q1, it's probably on our best, geologically based land. So, $80 is very economic, I think, assuming we achieve the IP rates that we expect. But, if you're looking to kind of blanket the Cardium area, I'd say probably 90 and up is where we'd be comfortable drilling.
Okay. And I mean, I know the answer to this, but if you want to remind us, like some Cardium is gassier than others. And what's your GOR on your Cardium?
Yeah, so this wouldn't be as gassy. I think our GORs here probably in that 2,000 to 3,000 range. And then actually, since you're asking that question, our Montney is not in that super liquid rich area either. It's more
pretty dry.
It's probably 30 to 40 barrels a million in our Montney. So, hence why we'd be looking to target that at a little bit higher price deck than say some north in the really liquid rich Montney.
Let me see. We've gone over the reactivations. So you've participated in 14 gross wells. And as a result of that, how many locations I mean, you can only guesstimate right now, I understand, but how many locations do you think you have unbooked in your reserve report as a result of this year's drilling program thus far?
How many locations have we added?
Yeah, that aren't booked in your that aren't booked.
Yeah, so part of the strategy this year with the drilling program was to basically try and add to our inventory list. So we weren't drilling, direct step out after step out, more infill locations, just converting a PUD or a probable to a PDP. We were trying to extend some plays.
Yes.
Because of that, we had some great success, and we drilled a couple wells that we weren't as happy with, but it tested the edge of the pools and things, and obviously our production levels still were in line with our target. So I think corporately, a successful quarter. But there were a couple that wouldn't have added locations. So of our and I don't have that number off the top of my head, Jess, but for the most part, I'd say probably 75% of the wells we drilled on a gross level would have hopefully added a location, an offsetting location to our book. But I guess we'll see as we work through our reserve report where that lands. But our strategy this year was to try and take a few calculated risks, I guess, and push that out a little bit. And we had some success, and that's we were happy about that. But I think it's going to take some additional capital in certain areas to really develop out the pools, and both in Southeast and then up in Kaybob. So I think overall successful year thus far, but more work to do.
And if I may, part of that thesis is to have those locations drill ready. That it's our belief that we're going to see better days for oil prices in 2023. And if we've got a number of locations that appear drill ready, and we have a strong understanding of what the economics will be, we can go out and drill those quite quickly and bring on the production and take advantage of what we think is going to be a favorable oil price for 2023.
Yeah, so you can move quickly, and unlike some others, you have no problem getting service providers, etc. Like you said, you've had a bit of issue for tie-ins, but as far as drilling,
that's been the only challenge really. It was on some pipeline construction, a little bit of facility work, things like that, where we've been pushed out a bit. But on as far as securing a rig, we had one steady rig in Southeast. We've had anywhere from 3 to 4 service rigs working for us at a time, depending on if it's in Southwest or a combination of ARO work and completion work or workover work. So yeah, we have a really good relationship with all of the service rig companies in Southeast, and we've secured about 10, maybe 12 wells of pipe, both casing and tubing, direct from manufacturer over the last 2 months. So we have that in place for Q1 and into Q2, which is really, really good. And I think a benefit for us, given that prices, continue to slowly kind of tick up even today. So securing some of that pipe at a price that we were able to about 6 weeks ago, I think was pretty important for a company of our size, and just to make sure that we have that in place when we move to drill.
Yeah, it was my next question. It was inflationary pressure. You're still seeing some.
Yeah, a little bit. Yeah, I think, I don't know when that's gonna kind of stem or when it's gonna flatten out. It's definitely not to the extent that it was, but it's hard to predict. And I think doing what we can as a company to secure services and try and lock in some rates where we can, I think is important. And, that's what we're trying to do.
Okay.
We could also pace our capital. So I mentioned, expediting our program if oil prices increase, but we also have the luxury to reduce the amount of capital that we spend as well, in light of either inflationary pressure or a drop in oil price or gas prices.
Yeah.
Yeah. And one other thing I just wanted to note, obviously, we speak to it a lot just given where prices have gone, and our hedges right now in Q4, I think we're in that 97 a barrel range, and it's about 65% of our production right now, of our oil production, maybe a hair less, but I think we're $15 to $16 in the money right now. I think it's at 97 and we're sitting at $81, give or take. And, into Q4 or into Q1 rather, it's $91 a barrel US. So I think, positionally we're in a good spot in terms of our oil revenue moving forward. And, that allows us a little bit of flexibility, of course.
So two questions there. Some people would ask if you would, monetize those hedges, but I think with your counterparty, you can't. Is that fair?
That's right. Yeah. So we have a hedge secured with a counterparty that's actually a part of our debt facility, and so there's no way to exit or cash out on any of that debt.
I guess the way that we could choose to liquidate, our hedges would be is if we replace the debt. And again, we're always looking at opportunities to try and drive down our cost of capital. And as we pay down our debt, I think there's an opportunity to explore conventional debt. So that's something that will continue to be on our radar as we enter into 2023.
And are you getting more? Of course, the banks pulled out, pretty dramatically during the downturn. Are you starting to see more interest from banks offering RBLs and taking a closer look at re-entering the sector? I know some won't at all, but
yeah, I think there's the select few that are starting to re-engage with companies like us, and as long as you meet their criteria and their thresholds, I definitely think it's an opportunity for us here as we get into Q1 to replace that vehicle. And so, yeah, I guess the quick answer is yes, but you have to, meet their criteria, and it's only a subset of maybe one or two banks right now that we're familiar with that are looking to, extend some capital to companies like us.
Yeah, most would have to see like 20,000 barrels a day plus, I would assume.
Yeah, exactly.
Yeah.
I think for the longest time, obviously during the downturn, like 10,000 barrels a day for sure was the minimum. And
yeah,
I think they probably still prefer that, but for smaller companies, they'll look at you if you can meet the thresholds that they require.
And I also think that our history with some of these banks previous to ROK in our private cos, we've got relationships with certain institutions that, they may be able to step outside the 20,000 barrel a day range or whatever that looks like. And I also think that banks now are looking at it more as a holistic approach where they're saying, we want your hedge business, we want your M&A, we want your banking, we want all of those things. And again, I think there's an opportunity to hopefully to extend on relationships that we've had in the past, and which we think will benefit shareholders.
Yeah, you definitely have deep relationships going back through your prior iterations. And now that I think that some of the banks see the possibility, and they're seeing in some ancillary business again, that they, before they pulled out thinking there was no other, the RBLs were lost leaders for ancillary business, but now there's been, a lot more M&A, some financing. So, that certainly should entice them to want to lend. And again, given your depth of relationships, that's a definite benefit.
I agree. And I think part of it is, the strength of our hedges does help when in having those conversations, right? And so they see that we're already hedged well above 50%, which is kind of what they look for.
And on the hedging subject, you don't have to hedge anymore as far as Anvil's commitment goes?
Yeah, we hedge 50% on a rolling 24-month basis. So as we look out to what we're November now, so 2 years out, 50% of our declining PDP. So it would work out to well under, I want to say 30 to 40% of our production based on our forecasts. So there is that rolling requirement. That said, our debt, they understand, as do we, that our debt is fully repaid prior to that.
Yeah, that's what I was sort of getting at. Yeah, you should be, because whatever, depending on oil prices, but you should be, debt free by end of next year. Is fair?
Yeah, for sure by Q1 of 24. Yeah.
Okay.
Which, if I mind just touching on the hedge, which gets us, excited about our strategy of having drill-ready locations in the event oil prices pop. Obviously, that production would come on all unhedged. So we've got the hedges in to protect us, to protect our shareholders in terms of the debt facility that we've got. But we've also got the ability to bring on production quite quickly in the event oil prices pop in 2023.
Wouldn't accelerate your debt repayment.
Right.
Yeah. Now, given that you've added some production, you had a pretty low decline rate before. I think was around 18% when you bought the FCL assets. What do you think your corporate decline rate would be right now?
It's probably in that 25% range, I would say.
Okay.
And part of that, the reason why I would suggest it's lower than some of our peers, at least, is because we've got 500 barrels a day of production coming out of the Midale unit, which actually has inclining production with a bit of maintenance capital. So, obviously that complements our corporate decline.
Yeah, for sure. That's a nice backup to have.
Yeah, sorry, that and our Kaybob gas production, I think the bulk of it is some pretty historic, flat decline producing assets. So those two together, backstop, I guess, our corporate decline. And obviously, as we add in Southeast Saskatchewan wells, it could have a 75%, year one decline rate. That provides that backstop to keep it sub 30% corporately. So yeah, we understand as we drill Frobisher wells and even Midale wells that you start to kind of come on that treadmill a little bit in terms of what those IP rates look like and what that first year decline looks like. But that's part of those assets and part of those really, really quick payout wells, right? And so there's good and bad, and it's mostly good. So
yeah, and then it becomes harmonic and it gives you a good base. So
that's right.
Yeah. Now, how many wells, do you still have to tie in before year end?
I think we have about three, give or take 3.5 net wells to bring on, and that's southeast, a couple non-op wells, one op well, and then out in a Kaybob we have that horizontal Gething well that I mentioned. So, and then hopefully an additional well on that reactivation program. But I just don't know the timing on that given the infrastructure delays with TCE right now. So that may get pushed to Q1.
So we could see a little bump to the 3,500 from here.
I hope so. I think it's really going to be contingent a lot on that Kaybob gas, to be honest, and getting some of that non-op back online and producing through, I guess, the remainder of Q4, which we're already about halfway there. So, we expect a strong quarter.
Okay. Now, just on the M&A front, with price volatility that we've seen over the last, couple of months, are you seeing more for sale in the M&A market? Last, I know there were some packages that came out, over the last few months that were up for sale. And I know you guys also know your asset, especially in Southeast, your asset base very well as far as the private cos that are in that area that might be for sale. Are they coming down on price at all, or are they still? Is it still hard to get a deal done given volatility?
Yeah, I'd answer it as there's a lot of product out there right now. We did see 2 large packages. We are continuing to evaluate what's out there, both in the private and public space. Volatility creates a bunch of issues in terms of the delta between buyers and sellers. But we'll continue to evaluate the core areas that we understand really well, whether that be in Southeast Saskatchewan or in Alberta. And we're hopeful that in 2023, we will have some growth via strategic acquisitions that will hopefully add locations and add to our narrative going forward. But there's a lot of product out there, and we'll continue to evaluate.
Well, so, I mean, that should actually work in your favor with the amount of product that's out there, given what oil prices are doing right now and the uncertainty surrounding China, going back to, lockdowns, et cetera. Should work in your favor. I would think that some people would come down in price.
Yeah, we can do a similar deal like we did with the Federated Co-op asset and buy it at $70 and watch oil prices trend to 128. That would be great. But you hit the nail on the head. There's a lot there is a lot of product. We don't think there's a lot of consolidators in the space either, in that 100 to 3,000 barrel a day range, and we think we can play a role in that.
Yeah, and if you want to remind people, like, you're pretty darn good at your acquisitions, and as far as not just buying something for production, you actually look for running room and growth from those acquisitions as well.
That's our strength is our technical team and their ability to identify opportunities that may otherwise be overlooked, and part of that is we've sold a bunch of those assets to some of these producers, so we've got a deep understanding of the asset base and the potential running room. So not only are you getting the base production, but we think that we're adding, or hopefully going to be adding, locations in the event we're able to do something on the M&A side.
And on the land side, still seeing lots of opportunities to pick up strategic land positions?
We think so. I mentioned that we picked up 5 sections of Crown land at the Alberta Crown land sale. We've picked up a couple sections of Crown land in the Saskatchewan sale. We've acquired some land through other producers. And I think the Saskatchewan piece, we've picked up some land where, the offsetting acreage or acreage in the trend acreage, if I can call it that, have gone for as high as $2 million per section. So, that's not indicative of, I guess, the reserves in the ground. And the reality is when we elect to drill on that, we'll have a deeper understanding of what that's worth. But we are acquiring what we think is some prospective acreage, and we'll continue to do that.
I think if you look at our track record, that's how we've grown companies in the past. We've never really been acquirers, and so we're always going to be looking at land sales. We're always going to be posting, perhaps, but at least at a minimum evaluating and reacting to postings, both in Saskatchewan and Alberta. And so that's going to play a key role in continued growth for the company, is picking up Crown land with really attractive royalty rates and drilling wells. And that's what we believe we're pretty good at. So yeah, that's going to be a part of that. There's going to be acquisitions, there's going to be some drilling growth on those lands, and there's going to be some raw lands and some new plays that we'll come up with. So,
well, that's what I really want to highlight again to the audience, that, I mean, you built 4 companies from basically nothing to completely or organically, from just land to, and then and built them to a point where 3 different producers wanted to buy them. So, which there aren't very many groups out there that do that. Most grow through acquisition. So.
Right. Yeah. It was, that was during a time when there was a big Bakken boom and some Idaho booms and things like that. And we've been able to take our knowledge of those basins and we always drilled Frobisher in the mix of those companies as well. And so really it's kind of going to be a, Mississippian based Frobisher Midale story in Southeast. And then, using our, technical knowledge to grow K-Bob in some different pools and some different formations, but kind of, the same type of logic. So yeah, it's a cool set of assets that we acquired, and we're excited about continuing to develop it.
Awesome.
I see a question here. It asked if there's any possible revisions to stock price forecast, example, Beacons, Peters, etc. So
yeah. Well, we can't really answer that.
No, we can't, but we can identify that Beacon and Research Capital are the 2 that are currently covering ROK. Is that fair to say?
Yeah. But as far as an analyst revising their target up, that has to be their decision. I don't know.
It's out of our control. Obviously, we'll continue to, provide them insights when we can and where we can. But yeah, that's ultimately their target. And, I think I saw Beacon came out with maintaining the target price of 85 cents or so. So I think that was today.
Well, and I think we had a pretty successful marketing program a few weeks ago in Toronto, where we saw a lot of new accounts, etc. So I think the story is really getting a much broader audience than we've had, when we first started back in April. And one question, dividend.
I can answer that. And there's also a second question on buying the warrants out in the future. And I think
I see that one now. Okay.
Those kind of go hand in hand, I think, for us. I think 2023 is about providing optionality to not our shareholders, but optionality corporately, where we can take our free cash flow and make decisions to either invest it in the ground or through M&A or through potential share buybacks, warrant buybacks, dividend, those type of things. And I don't think we have a good answer in terms of what that looks like, because in the moment, we're going to evaluate that and make decisions. But we think 2023 is going to be framed out as optionality with our free cash flow to hopefully make good decisions for our shareholders.
Well, that's what
I just want to add to that. So our focus this year, and I'm pretty sure we had provided this insight to the market after the acquisition, was to pay down debt and, drill some wells, try and grow a reserve base, maintain or add to production, with, 2023 being a year where we can sit back a little bit and reevaluate where our cash flow is coming from and what it looks like on a free cash flow basis. The end of Q1, I think we'd be targeting, hopefully a consolidation, or at least having the conversations about a consolidation of that debt and looking at, something more conventional, whereby we're not paying so much in principal back and more of a revolving line, as Jess mentioned earlier. So, a few things have to happen, I think, before either A, dividend, B, warrant or share buyback, C, reinvest that into the ground and just continue to grow. So I think that's when those decisions are made, and when, the market will kind of learn of that strategy. So until then, we'll continue to pay down that debt aggressively, which we've done, and, and push forward our drilling program.
We are highly motivated. Sorry, Jess. We are highly motivated to see that happen, though, with insiders owning 18% plus of ROK today. We want to see shareholders rewarded, and so that hopefully will be part of what 2023 looks like.
Yeah, there's a lot of balls in the air for you in order to make capital allocation decisions at this very moment, until you determine, whether what you're doing with, like you say, consolidation of debt or what have you. And on the warrant topic, I mean, it's something we've discussed to death, whether or not to buy those back and what, but it's
an option.
It is.
There's some shareholders love the idea, others don't. As a management group, I think we're, we see the value, but at the same time, it's that buyback versus dividend question that I think is ongoing in the markets right now, especially in oil and gas. And so, again, and then for a company of our size, our plan, or at least, one of the potential strategies, right, is to grow a little bit more aggressively than a lot of these companies. And what have we always done in the past is build companies to sell them. And so that, of course, is an option.
Well, you've certainly done a phenomenal job, digesting the FCL assets very quickly without a hiccup again, growing the base of production that you've already had. And so you've done a phenomenal job in 9 months. It's 8 months. It's hard to believe it's only been that long. And so congratulations. Very pleased.
Yeah, thank you. I think we're critical of ourselves, and there's probably ways to be a bit more efficient as we move forward. But I think you're right. Bryden hit the nail on the head as well, saying it's been 7 or 8 months, and it feels like it's been 7 or 8 years. And I think that's just a pure obsession with the asset over that period of time. So I'm excited to see what 2023 looks like.
Well, and I think another thing to focus on too is the areas that you're growing in. You don't have a ton of competition either, as far as acquisition, whether it be land or corporate. Is that fair?
I think that was right 7 months ago. I think that's changed. over the course of the last little while here. And I think part of that is the understanding of the economics on the Frobisher potential. And we're seeing it, as I mentioned before, like land sales, where you've got $2 million a section on some of those key parcels. So there is more activity, but again, what I think we're good at is taking the acreage that we've got and acquiring strategic acreage to complement it and grow. But we are seeing more competition, which we think is a good thing.
So significantly more, or like I'm not talking Clearwater competition.
No,
I'm talking, more.
There's a lot of talented, smaller private companies out there with capital now. I mean, everybody's had some, a good year here of cash flows, right? And so I think the companies that know Southeast really well aren't afraid to pay up at land sales and things like that, and for acquisitions that make sense. Like, the $2 million a section is a private company that we know really well. So I think that's more what Jared was referring to, maybe less the big companies, the big publics. I mean,
that's where I was going.
So Surge is quite active. They're obviously a company that's been very aggressive in Southeast. Whitecap, not as much. They're actually looking, I think, probably to focus on the XTO lands they bought, and they're, as evidenced by the package they put out, they're divesting of certain areas in Southeast. And so you got some bigger ones out there and some bigger ones moving out, but there are a lot of smaller privates that, again, provide opportunity for us as an acquirer as well. So I think competition's okay right now. It means there's value out there.
Well, I think we've covered everything. Again, congratulations on a great quarter, and keep up the good work. I'm a very happy shareholder. Oh, there's another question. Just a second. Oh, thanks, guys. Good work.
Thank you, guys. Thanks for tuning in. Whoever's out
there. Thank you for the support.
Yeah, no, and continue doing what you're doing, because it's working. So thank you.
Okay, thanks, guys.
Okay.